In 2008, John Stein, a 30-year-old entrepreneur, revolutionized the world of finance with the launch of Betterment, the first ever Robo-Advisor, a digital platform designed to manage and balance clients' assets. It quickly expanded globally and transformed how people invest. Today, the total global assets under management in Robo-Advisors have reached a staggering $2.45 trillion, which is only expected to grow. While large Robo-Advisors have already made their mark in the US, and this innovative approach to investing is still relatively new to Australia. So in this video, we'll explore the top 5 Australian Robo-Advisors and answer the burning question, is Robo-Advisor worth exploring? According to Wikipedia, Robo-Advisors are self-guided online wealth management service that provide low-cost automated investment advice using fancy portfolio management algorithms. But what does that even mean? For the Robo part, financial advisors and investment managers set rules for investing, and the software uses those rules to allocate, manage, and optimize clients' assets automatically. For the advisor part, Robo-Advisors provide personal financial advice in addition to general financial advice, and that means that they ask personalized questions about your financial situation to suggest a customized investment plan. Sounds great in theory, but do they actually deliver? We're going to find out. Despite sounding like a high-tech solution for investment management, using a Robo-Advisor is actually incredibly easy. All you have to do is go online and answer a few simple questions about your financial goals, investment time frame, and risk tolerance. And based on your responses, the Robo-Advisor will provide you with a statement of advice and recommend an investment portfolio. If you decide to move forward, the Robo-Advisor will take care of the rest, managing your portfolio on your behalf. No more stressed decision-making or worrying about market fluctuations. It's simple, convenient, and low cost. While using a human financial advisor in Australia can cost around $3,000 on average, and Robo-Advisors offer a more affordable alternative with lower capital requirements, normally starting from $2,000 and no need for meetings or paperwork. And plus, their transparent design allows you to easily access information about your portfolio online all in one place. However, Robo-Advisors are not perfect. Despite their aim to provide personalized investment plans, in reality, they often offer limited options for investors to choose from. Many Robo-Advisors offer fixed asset allocations that fall within a broad categories such as conservative or aggressive growth. Another disadvantage of Robo-Advisor is the lack of human interaction. It means that investors may miss out on the reassurance and support that human advisors can offer during periods of market turbulence. For example, the market experiences a big correction and is down 5% in a week. Your Robo-Advisor won't start panic selling no matter how attempting you are. Sometimes this type of assurance from a professional is important in such an emotional crisis. Yes, many of them do have customer service phone lines to call up or live chat, but let's face it, it's not the same as speaking with a financial planner with decades of experience who knows your financial situation. In Australia, there are currently 5 major players in the Robo-Advisor market. StockSpot and InvestSmart both were established in 2013, Quiet Growth in 2015, SixPark in 2016, and OpenInvest in 2017. Unlike self-directed micro-investing platforms, all of these Robo-Advisors provide chat-sponsored shares under the customer's names. And this means that when you want to exit, you can easily transfer your assets to another broker without having to sell them. And this provides investors with greater flexibility and control over our investments. The minimum investment requirement is typically starting from $2,000, with OpenInvest setting the highest bar of $20,000. Let's dive into the 5 major Robo-Advisors and see what they have to offer. You might be surprised to know that they all provide a similar range of diversified portfolio based on your risk tolerance, just like superannuation funds. For instance, StockSpot has 5 standard portfolios that use gold, bond, and share ETFs as building blocks, and they also offer sustainable portfolios that have a matching growth and defensive asset allocation. SixPark similarly offers 5 standard portfolios and 5 ethical portfolios. If you take a closer look at their chosen ETFs, you'll find that they include REITs, infrastructure shares, and money market funds, but no gold ETF. InvestSmart not only has 5 diversified ETF portfolios, but also offers 5 single asset ETF portfolios. And finally, OpenInvest uses fund managers from JP Morgan, Schroders, and BlackRock, making it a bit different from the others, although it comes with the highest fee. When it comes to cost, there are two types of fees to consider. The management fees charged by Robo-Advisors and the expense ratio deducted by the fund's return. Regardless of whether you choose to invest on your own or use a Robo-Advisor, the expense ratio is applied at the fund level. And Robo-Advisors typically structure their fees based on account balances. For example, if you have a 50,000 initial balance with 1,000 monthly top-up, the annual fees for each Robo-Advisor would be as follows. Paying these fees means that you can sit back and let the investment run on autopilot. However, if you choose to manage the investment yourself using a self-directed platform like, for example, Stake, which charges a brokerage fee of $3 per trade, and make one transaction per month, and your annual cost will be $36. So far, we've talked about the pros and cons of using Robo-Advisors in general, and we just compared the top 5 Australian Robo-Advisors in terms of their minimum investment, portfolio options, and fees. And I guess one of the reasons that you are watching this video is that you're looking for a platform to invest. So is it worth to use Robo-Advisor for the long term? To solve this puzzle, we finally need to see its total net returns after all fees, with those of investing in one fund ETF, VDHG, Vanguard Diversified High Growth ETF as an example, using an online broker Stake. Let's call these two teams Team Robo-Advisor and Team DIY. And I have chosen the highest net return from portfolios among the 5 Robo-Advisors, and here are the total returns after all the fees have been taken into account. And Team DIY's total net return is 8.042%. So far, only OpenInvest outperforms the DIY returns. If OpenInvest can consistently carry the outperformance, we should choose OpenInvest for sure over investing ourselves. However, I would rather pick a medium net return, which is 7.5% annually from StockSpot, which underperforms the DIY option by 0.52%. This can be considered a premium price for saving you the time and energy to research and manage your own portfolio. For a balance of $50,000, this will be $271 per year. And if considering the compounding effect with a $1,000 monthly top-up, in 10 years' time, you will pay $5,662 as the price, or in other words, you will lose that money in return. Different people have different benchmarks to make the decision. If you think $271 per year is worth your time and hassle to pick and construct your own portfolio, definitely a Robo-Advisor can be considered. But for others, $271 per year might be a hefty price to pay some Robo-Advisor while they are confident and can easily manage their portfolios. But luckily, all of the Robo-Advisors offer chat-sponsored ETFs, so we don't need to worry if any of them go under. And you can also change your mind halfway through. Well, Robo-Advisors can be a good option for long-term investing, but it depends on your personal preference and how much you value your time and energy. Thank you for watching, and if you have any insights about Robo-Advisors, please share them in the comments below. My name is Irene. I'll see you next week. Bye.